Conventional wisdom and popular personal financial advice suggest that portfolios should contain at least some bonds and that asset allocations should shift increasingly into bonds as investors move toward retirement. Investors often use rules of thumb like 100 minus their age in stocks, or they use target date funds which systematically shift from stocks into bonds over time. This seems sensible given the perception that portfolio risk should decrease as retirement nears and progresses, but it may rest on flawed assumptions. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you why it might be time to rethink traditional asset allocation advice. Asset allocation is the mix of stocks, bonds, and other assets that make up an investment portfolio. Different assets tend to have different return characteristics and tend to interact with each other in different ways. For example, stocks and bonds don't usually move up and down in lockstep. Asset allocation should also take things like human capital, the ability to earn income, into account. Most lifecycle asset allocation models suggest portfolios containing a mix of stocks and bonds, with the allocation to bonds increasing as people age. This advice is consistent across textbooks, industry courses, and popular personal finance books, and it's codified in target date funds which manage trillions of dollars of investors' assets. Fundamental to this advice is the idea that volatility in investment returns measures the risk of an investment. Risk is a complex topic, but for long-term investors, while volatility is certainly important psychologically, it may not be the best measure of risk. Risk should be measured, at least in part, as the probability of not meeting your future consumption goals. The extent to which volatility is risk for a long-term investor largely depends on how volatility is related to expected returns. If your stock portfolio drops by 20%, you will feel sad, but if its expected return increases when the portfolio drops, your ability to meet your long-term goals may be relatively unaffected. Empirically, stock expected returns do seem to increase when stock prices fall. Major crashes are often followed by positive returns. This mean reverting behavior reduces the risk of stocks for long horizon investors. The question that follows is whether stocks provide better outcomes than bonds and cash in asset allocation for long-term investors. One of the keys to answering this question is dealing with the limited amount of available data on asset class returns while maintaining any mean reverting tendencies that may exist in the long-term stock returns that have actually happened. This work has been done in a recent paper titled Beyond the Status Quo, a critical assessment of lifecycle investment advice. To model asset class returns, the authors use a comprehensive dataset of historical returns on domestic stocks, international stocks, bonds, and bills that spans 38 developed countries and nearly 2,500 years of country month return data from 1890 to 2019. They use these data to simulate 1 million possible return scenarios. Importantly, their sampling method maintains the long-term time series return characteristics of stocks and bonds. The authors model the life cycle of a U.S. couple who saves 10% of their income during their working years and consumes during their retirement years. They begin to save at age 25 and they retire at age 65, receiving Social Security income and drawing down their portfolio using the 4% rule for retirement spending. With this data setup, the authors compare a bunch of asset allocation strategies on retirement wealth accumulation, retirement spending, the sustainability of retirement spending, and net worth at death. The big finding from the research is that rather than the traditional equity glide path represented by a target date fund or a stocks minus age strategy, or even a constant allocation to 60% stocks and 40% bonds, a portfolio of 35% domestic stocks and 65% international stocks for the full life cycle, that means from early savings right through retirement, is optimal across all measures. Domestic stocks in this data setup refer to a representative domestic country, where domestic is largely referring to stocks denominated in local currency. For example, a Canadian investor would allocate 35% to Canadian stocks, but an investor in the Netherlands would allocate 35% to Eurozone stocks. This does suggest a significant home country bias for investors in many countries, including Canada. That's a topic for another video. It's not surprising that an all-equity portfolio results in better wealth accumulation, but the finding that all stock portfolios continue to produce better outcomes throughout retirement is surprising. It's not only the average outcome for retirees driving the result either. The globally diversified all-equity portfolio produces better left tail or worst-case outcomes for total retirement consumption and a lower chance of running out of money. This holds true at 3%, 4%, and 5% portfolio withdrawal rates. One of the other surprising findings is that even adding 5 or 10% in bonds to the all-equity portfolio, something that many investors would consider sensible from the perspective of diversification, results in worse outcomes in the simulations. One of the reasons is that while stocks and bonds have low correlations at short horizons, suggesting a diversification benefit, At long horizons, domestic stocks and bonds have relatively high correlations. Similarly, while bonds are less volatile, they have much worse long-term downside risk in terms of purchasing power, and they don't tend to recover after crashes the same way that stocks do. I think the main insight from this research is not that stocks are safe for long-term investors, they're still very risky, but that bonds can be even riskier. Over long horizons, like 30 years, bonds become riskier than stocks, more correlated with stocks, and have worse downside risk than stocks. Another interesting point is that the dominance of all stock strategies is increasingly pronounced at longer lifespans in the simulations, where the probability of ruin for the longest lived couples in the model is much lower for couples investing in stocks than those investing in target date funds. I know this is all making stocks sound really good, but there is an important trade-off. The all-equity portfolio in the simulations is more volatile and has much larger drawdowns on average, which could be particularly difficult for retirees to endure psychologically. We know from other research that investors behave really badly with volatile assets. The gap between investor returns and investment returns, that is what investors tend to lose due to inopportune timing decisions in risky assets, tends to increase with volatility. Assessing how much risk, as measured by volatility, you can take involves, broadly speaking, an assessment of your psychometric risk tolerance, your capacity to endure short-term declines in the value of your financial assets, and your composure through past experiences with market volatility. It's great to say that an all-stock portfolio performs well over the life cycle, and it does, but the price you pay is increased volatility and drawdowns, which can manifest as a psychological cost, but also as a real drag on performance if it results in bad investor behavior. Financial advisors do have some interesting interactions with these findings. Some empirical evidence suggests that financial advisors boost the share of stocks in investors' portfolios and increase their ability to stick with their portfolios through major downturns. Contrary to traditional portfolio diversification and life cycle investing advice, evidence drawing on data from a comprehensive survivorship bias-free sample of stock and bond returns suggests that a portfolio consisting of 35% domestic and 65% international stocks, implying a home country bias for non-US investors, dominates balanced portfolios, age-based asset allocation strategies, and target date funds on achieving wealth accumulation, retirement consumption, and bequest objectives. Before people run off and dump their bonds, I have a few comments to finish with. We can't know how representative these historical data are of the future. It's possible that the equity risk premium, the expected return premium for holding riskier stocks over safer bonds, has decreased over time as markets have become more accessible and better regulated. It's also possible that the time series characteristic of returns that were carefully preserved by the sampling method in this paper may not persist in the future. Lastly, a lot of people simply don't want to live through 50% drawdowns. So, where does this leave life cycle asset allocation? I think investors at all life stages need to understand that volatility is not the only way to think about risk, and that less volatile assets like bonds and cash may be very risky for long-term investors. It's also important to understand that psychological tolerance for volatility should not be taken for granted when looking at data like these. There is a lot of uncertainty in estimating expected returns, and the future will never feel certain. Risky assets are risky, and their prices will tend to drop when scary things like pandemics or financial crises are happening. You need to be comfortable living with your portfolio every day, knowing that its long-term outcome cannot be known. With those caveats, I think it makes sense to use data like these to shift the distribution of expected outcomes in your favor. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you're in Canada and want to learn more about how PWL approaches portfolio management and financial planning for long-term investors, you can book a meeting with us below.